What's up, everybody? This is Sunko, the Korean bro. Today is 2023, July 24th, and here I am. It's been a long day since I did YouTube last time, and now I'm back again. I've been traveling around, and also I had to have some time off because I'm about to change, not my job, but I'm going to change my workplace soon. So in a week or so, I'll be going to different workplace. So okay, let's get back to uh, stock article, right? So see what do we have? First, I'm gonna look through what articles we have, and then at the end of YouTube Live, I'm going to look at um, Shopify in depth because that's the company that I want to know, um, and that's the company that I'm going to write about. So I'll be spending a lot of time on it, and so let's see. The top economist warns of a situation resembling the lead up to past crashes. Should you still invest in the stock market? Hmm. Here's top under the radar stock split stock to keep your eyes on right now. Hmm. Okay, we got a lot of articles tonight. And just so you know, I bought a new laptop and it's really fast. Okay, let's see. This top economist warns of a situation resembling the lead up to past crashes. Should you still invest in the stock market? Okay. The stock market is rallying even as consumers face a challenging economic environment. David Rosenberg, chief of Rosenberg Research, says today's excitement looks overdone. The S&P has climbed more than 20% from its bear market low. The stock market has given investors a reason to celebrate this year. All three major indexes are rallying after falling into a bear market in 2022. The S&P 500 has climbed more than 20% from its bear market low, prompting some to even say a bull market has arrived. But not so fast. To call a bull market, an index should also reach new highs. That hasn't happened yet, and some experts are sounding the alarm that things aren't as rosy as they seem. In fact, a top economist has warned that today's situation looks a lot like the lead up to past market crashes. Let's find out more about his comments and decide whether you should still invest in the stock market right now. Three past crashes. President of Rosenberg Research, David Rosenberg, said the market environment resembles the ones ahead of the 1929 crash, the bursting of the dot-com bubble in 2000, the financial crisis of 2008. His comments came in a research note this week, according to Market Insider. Hmm. The balloon does have a lot of hot air in it, he wrote. Rosenberg said that amid the market euphoria, consumers are struggling with rising inflation and finding it hard to borrow money. And the fear of missing out has kept some investors piling into the stock market, and just like the periods preceding past crashes. It's true that stocks have soared even as the economic situation remains complicated. We're still in a higher interest rate environment, which weighs on companies' cash and consumers' wallets. As a result, corporate earnings may suffer in the months to come, and that might hurt stock performance. Some economists have become more optimistic in recent weeks, saying the US won't slip into recession this year after all. Though the inflation rate remains above the Federal Reserve's goal of 2%, it's fallen to its lowest since 2021. That's encouraging, but at the moment it's impossible to predict whether the optimistic or pessimistic economic predictions will dominate and whether the stock market will continue rising, pull back, or even crash. So in this sort of situation, should you still invest in the stock market right now? The risk of short-term investing. If I were investing for just a few days or weeks, I would worry about buying stocks today. Or any day, a short investing window opens up the door to a lot of risk. One bit of bad news and your holding could decline in value. But here's the thing, the best way to invest and the shortest path to great returns is long-term investing. This means buying stocks and holding them for at least 5 years. Over that time period, you may experience declines, but you are more likely to see periods of gains. So this means if you do happen to be in the market during a downturn or crash, that's okay. Over the long term, you can still win. Take a look at this chart below showing the performance of S&P 500 from the before the 2008 financial crisis through today. The index has more than made up for any losses from even its steepest downturns. The technology stocks, often sensitive during times of market troubles, have shown their resilience over time. For example, Apple, Alphabet, and Amazon have all climbed in the triple digits over the past decade. All of this means you shouldn't worry too much about what direction the economy and the stock market take in the coming months. By holding your stocks long term, you give your portfolio the runway to make up any losses and go on to gain further. Now you might ask, well, why not just wait and buy stocks during the next sell off? That's because it's impossible to consistently time the market and buy at the very lowest level. The best idea is to get in when prices look reasonable, the long term outlook looks good. There are many stocks in this situation today. So, yes, it can be helpful to listen to what experts have to say and avoid stocks that seem overvalued. But anytime is the right time to invest when you choose carefully and plan to hold on to stocks for the long haul. So the point of this article is that you should hold on to it for a long-term period. If you plan to invest it in short-term period, you will likely to lose your money, but in the long term, or like 5 years or so, it's highly likely that you will win at the end. Uh, author even brought the charts of S&P 500 to uh, say that what he's saying is right, right? So here is top under the radar stock split stock to keep your eyes on right now. Um, okay, Twilio, Netflix. Okay. Okay, these undervalued growth stocks could supercharge your portfolio in the long run. Twilio. Twilio. Okay, cloud communications expert Twilio has dipped a long way below its all-time high of February 2021. Despite a 27% gain so far in 2023, the stock price stands out here, raising 85% below the lofty all-time high. This might seem like a daunting decline, but savvy investors are seeing that dip as a prime opportunity. For example, growth investing phenom Kathy Wood of ARK Invest has been building her Twilio position with several buys this year. The stock remains one of her favorite plays on artificial intelligence. Thanks to years of severe and world-class consumer businesses like Uber and Airbnb, Twilio has built a unique collection of customer data. This data that is right for AI-powered business analysis. And let's not forget that Twilio's directly addressed market is pretty impressive too. Thanks to years of serving world-class consumer businesses like Uber and Airbnb, Twilio has built a unique collection of consumer data that is right for AI-powered business analysis. And let's not forget that Twilio's rightly addressed market is pretty impressive too. Communication platform as a service market where Twilio solutions reign supreme is expected to nearly quadruple from 12.5 billion last year to 45.3 billion in 2027. Even a conservative estimate of Twilio's market share in 2028 would point to biffy double-digit annual revenue growth over the next 5 years. The company's annual revenue could close in on $12 billion by the end of the span. The company faces some short-term headwinds, resulting in a slowdown of its revenue growth. However, these issues look like temporary potholes on the road to a promising future, and as Twilio continues to integrate AI into its platform, it opens the door to additional growth opportunities while also solidifying its leadership in the CPaaS market. So I see lots of room for the stock to run higher. With its dual focus on AI and CPaaS, Twilio lays the foundation for a strong comeback. It may take a while to fully repair last year's price drop, but patience is a long-term investor's best friend. All things considered, this summer seems like a great time to follow Kathy Wood's example and grab some Twilio stock at an affordable price. So now we have Netflix. Okay, Netflix. There's a video. John Netflix was patching up its stock chart damage quite nicely until last week's second quarter earnings report led to another setback. Patching up its stock chart damage quite nicely until last week's second quarter earnings report led to another setback. The company delivered muscular bottom line earnings. And 5.9 million net new subscribers. Free cash flow also soared to 1.3 billion, $1 billion dollars, and management painting a long-term picture of steady growth in cash profits. Yet some investors wanted more, and Netflix stock price has dipped 11% lower since Wednesday evening's business update. More Netflix stock price has dipped 11% lower since Wednesday evening's business update. Even so, Netflix shares have climbed an impressive 44% year to date. Some investors taking their short-term profits off the table. And I think that's a huge mistake. This company has reshaped the entertainment industry by sheer force of will and passion business acumen. More than once, after dominating the home video market in the era of physical DVD and Blu-ray disc, Netflix moved on to create a global video streaming market from scratch. Now, every media company worth its salt wants a streaming service of its own, hoping to copy Netflix's proven success in some way. But Netflix isn't sitting still. The worldwide market growth has a long way to go, and management keeps coming up with new ways to boost the top and bottom lines. Ad supported subscription plans are reportedly more profitable than their ad free alternatives. So Netflix won't let new subscribers in the US, UK, and Canada sign up for the basic no ads plan anymore. Oh, and I think we'll see a revenue generating version of Netflix's growing video gems catalog someday. The management long-term plan is still mind-boggling ambitious, comparing the streaming opportunity to the rise of cable and broadcast TV in the 1950s. Netflix wants to lead a global revolution that makes linear TV services as obsolete as copper cable phone lines and the horse-drawn buggy. Those targets are a long way away. Netflix is holding on to sector-leading throne with both ends. You can buy your stock on any significant price dip. The share price remains at least 32% below the highs of November 2021. Or it looks like a great time to pick up Netflix stock on the cheap. Hmm. Okay. Okay, let's look at Pinterest. Okay, Pinterest. Hmm. Okay, Pinterest is a unique social media platform that tends to attract people looking to spend money, naturally making it the ideal app for advertisers to invest in. It ended the first quarter with 463 million users, with Gen Z representing the fastest growing demographic on the platform. As the advertising market rebounds from its recent slump, the purchase uh, intent of the Uber base is an attractive revenue as the advertising market rebound from its recent slump, the purchase intent of the user base is an attractive revenue growth opportunity that could send the stock higher. There are already signs of advertisers shifting investment over to Pinterest. For example, Mazda partnered with Pinterest to market the launch of its new CX-90 SUV after reporting a sharp deceleration revenue growth over the last year. Pinterest reported slight acceleration in the first quarter, with the top line growing 5% year over year compared to 4% in the previous quarter. A near-term catalyst for further acceleration in revenue is Pinterest's new partnership with Amazon. This will enable users to shop ads with a seamless integration of Amazon's e-commerce business. Uh, enable users to shop ads. Shop ads with a seamless integration. Users to shop ads with a seamless integration of Amazon's e-commerce business. New partnership with Amazon, which could accelerate revenue per user. This top social media stock is down 66% from its peak and is a timely buy right now. I expect the company to post 7% revenue growth this year before accelerating to 14% next year as the advertising market recovers. Pinterest should sustain above average revenue growth and deliver market beating returns for shareholders. Okay. Roku, tech stocks are on the rebound, but those two still have plenty of upside potential. Tech stocks took a beating last year, but a new bull market could already be in the works. It actually soared in 2023, up nearly 35% year to date, paced by investor interest in artificial intelligence. But not every tech stock has bounced back. In fact, there are still some drop dead volumes in the market. Um, Unleashing long-term growth in the global cord-cutting market. Okay, media streaming technology as per Roku may not look terribly undervalued right now. Mm. But then you're missing a few important details. Mm. 2023 looks good, but last year was brutal despite the large year-to-date gain. Roku stock is still down by nearly 20% in 52 weeks. That's not even the worst of it. Looking back to the true peak from 2 years ago, you'll see Roku trading more than 80% below its all-time high. At the same time, Roku's trailing sales increased by 54% in 2 years. Not too shabby for a business that was supposed to have hit a brick wall in 2021, right? The inflation crisis appears to be over. The ad buying departments of major brands and retailers should have access to meaningful budgets again. When they do, Roku offers a highly targeted ad platform with 72 million active accounts and rising viewer engagement. Roku stock comes with a ton of paint up ad spending that is ready to break loose. That's not a short-term growth catalyst to have in your back pocket, but the bigger story is that Roku has only just begun to nibble on the massive global market. Consumers around the world will surely transition from a cable and broadcast TV to digital streaming services over time. Those 72 million active accounts could grow into hundreds of millions or more in the long run. The company acts like hungry upstart, cheerfully sacrificing short-term profits in order to keep the pedal to the long-term growth medal. Despite the challenging market environment, Roku boosted its R&D budget by 34% year over year in the first quarter. Selling and marketing expenses rose 60%. That's why I keep pounding the table for Roku. It isn't some short-lived gadfly, but an undervalued long-term growth story. Still in its early chapters, Roku's buying window is still wide open. Offshore, okay, is there a style in the market that's been more erratic than offshore over the last 2.5 years? Consumer lending platform went public in December 2020 at $20, rocketed out to more than $400 per share by late 2021. When the market crashed in 2022, interest rates surged, offshore fell at way back to $12 per share, shedding about 97% of its peak value. Now with the economy seemingly on the mend, the stock's rebounding again, up past $50 That kind of volatility might scare away some investors, but there's a good reason for it. Demand for loans dried up last year, and amid fears of recession and high inflation. Offshore lending partners grew skittish as well, but this should start to change as the economy becomes more stable. Offshore has a solid business model. The company uses artificial intelligence technology to rate creditworthiness so it can originate and service consumer loans, reaching demographics that have been left out by traditional lenders. Its algorithm does a much better job than in conventional vehicle scores. Uh, For example, the company says its models achieve 53% fewer defaults than large US banks at the same approval rate, or 173% more approvals at the same default rate, almost triple what large banks are able to do. Once the credit market starts loosening, upstarts should return to growth. And that's likely to be soon as the Federal Reserve seems nearly finished with raising interest rates and fears of a recession have receded. Upstart is also expanding beyond the consumer and auto loan markets into home loans, with plans to launch a home equity line of credit product later this year, showing there are still large untapped market for it to penetrate. Return to growth. And that's likely to be soon as the Federal Reserve seems nearly finished with raising interest rates and fears of recession have receded. The stock doesn't have to return to $400 to be a winner if the economy continues to improve. Expect Upstart to keep matching higher. Okay, let's go with Snowflake. Okay, Snowflake. Oh, too bad that I didn't buy Snowflake. Hmm. Let's see. Snowflake. Okay, let's see what Snowflake is. Okay, artificial intelligence is just the beginning of this. For this data specialist, there is a compelling argument that 2023 will go down in history as the year artificial intelligence came of age. The ability of generative AI to eliminate repetitive tasks, summarize data, and even simplify code writing has business scrambling to profit from the promise of increased productivity. Experts are still probing the potential represented by AI. Estimates vary widely. AI should increase the productivity of knowledge workers more than fourfold by 2030, predicted Kathy Wood, CEO of Art Investment Management. The company's Big Ideas 2023 report estimate that if vendors were to capture 10% of value created by their products, AI software could generate up to $14 trillion in revenue in 2030. Because of the potential for significant gains, investors searching for a wide to uncover candidates positioned to benefit from the AI gold rush. Searching far and wide to uncover candidates positioned to benefit from the AI gold rush. This is especially true for stocks whose prices are still reeling from the downturn. As a reserve analysts are remarkably bullish both about the prospects of one former high flyer and investors' favorite. In fact, if Wall Street has it right, the stock could soar as much as 223% over the coming 12 to 18 months. Knowledge is power, or so the old saying goes. Over the past decade or so, there's been a tidal wave of data from a growing number of sources over the past decade. Some reports suggest 99% of data has been produced over the past 10 years. And the veritable explosion of data will only accelerate from here. Companies can monitor, respect information sources, develop actionable data, but with so many silo systems and cloud providers, it's nearly impossible to aggregate it in order to make sense of it. Fortunately, Snowflake has the answer for it. The company's data warehouse offers a wide range of data processing, analytic, and storage solutions that Snowflake says are faster, easier to use, and far more flexible than traditional offerings. Because its database engine was custom built for a cloud, Snowflake can aggregate data that runs the gamut from third-party applications to cloud infrastructure platforms, making it all accessible through a central dashboard. Perhaps as important to users, Snowflake's transparent pricing is based on the volume of data storage, so it doesn't charge a fixed subscription fee. This allows customers of all sizes to pay for what they need and scale their use as they grow. Snowflake recently expanded existing agreements with Microsoft, Amazon Web Services, and NVIDIA to bring the power of large scale custom generated AI models, machine learning capabilities to the masses. These partnerships will give businesses the tools they need to build custom large language models that form the foundation for generative AI. Adding AI functionality to the mix will take the usefulness of this data to the next level, will likely be a born to Snowflake's business. Okay, enough of reading articles. The rest are about ASML, NVIDIA, and Duolingo. There's the ocean. Costco, Marco de Libre. Okay, let's read Shopify. Okay. Hmm. Hmm. Okay. Shopify is another stock Howell said she wouldn't sell. Once again, Shopify is not just a platform for online stores, it's a partner for entrepreneurs, creators, innovators, she said. I admire how Shopify empowers millions of people to start and grow their own business online. I use Shopify to run Toronto's website and e-commerce operation. It's easy, reliable, and scalable. I believe Shopify has a lot of growth potential and will continue to support the future of e-commerce. Koval. Anna Koval is a self-made millionaire who is the co-founder and CMO at Tarot 2, an online tarot reading platform launched in 2017 with a partner and her savings. She said that one of the most important lessons she learned is to invest in what you know and love. For me, that means investing in companies that align with my values, passions, and visions for the future, she Koval said. Hence, she won't be selling. Okay. So okay, now that we know who the Carvel is, and Carvel said that she wouldn't sell Shopify. It's not just an platform; it's a platform that helps entrepreneurs and a lot of it's not just a platform. Uh, it's a reliable, scalable, uh, and a lot of entrepreneurs use Shopify to have their own online store. That's what it is, right? Mm. Okay, July 22, 22nd. Shopify is benefiting from an improvement in e-commerce spending and still sitting on a large addressable market opportunity. These two high-flying stocks set for more upside. Okay, let's go. Shopify. A $1,000 investment Shopify stock at the end of 2022 has nearly doubled by now. Mm. Driven by the company's solid first quarter 2023 results released in May. Okay. Okay. Moreover, the company's decision to divest its logistics business and focus on its e-commerce platform seems to have boosted investors' confidence. The company delivered better than expected revenue growth in quarter first, with revenue increasing 25% year over year to $1.5 billion. Shopify's growth rate accelerated from the same period in 2022 when the company had a year over year revenue jump of 22%. More importantly, Shopify expects to sustain its healthy momentum in the second quarter as well, um, with a 25% increase in revenue over the year ago quarter. A gain that points towards significant acceleration when compared to the 16% year over year revenue growth the company delivered in quarter second 2022. This jumps in Shopify's growth this year isn't surprising given the potential improvement in the e-commerce market's prospect this year. According to eMarket, the e-commerce market witnessed the market slowdown growth in 2022 as sales grew just 7% following a 17% jump in 2021. This year, e-commerce sales growth is expected to increase by 9%. As a result, the demand for Shopify's e-commerce solutions, which help merchants bring their business online by helping them build a strong store on the internet, sell their products internationally, find customers through advertisements, collect payments, and get access to capital, should ideally improve this year. And analysts anticipate Shopify's top line to jump 20% in 2023 to $6.7 billion. But it won't be surprising to see the company delivered faster growth, considering the trends in the first two quarters. Our Shopify is setting on a total addressable market worth $160 billion, which means that it could keep growing at a nice pace for a long time. This explains why the company's revenue is expected to increase over the next couple of years. However, investors will have to pay a rich multiple to benefit from Shopify's growth. The stock sports a price sales ratio of almost 15. This is substantially higher than the sales multiple of 8 at the end of 2022. But then Shopify is relatively cheaper compared to its 5-year average sales multiple of 30. The company's stronger growth this year, along with the massive long-term revenue opportunity, suggests that it can justify its rich valuation, deliver more upside, which is why someone with $1,000 of investment cash might consider buying Shopify before it's too late. Commerce everywhere, rising margins, prices, right? Okay. Fits into this category. fast track toward profitability. E-commerce platform stock has roughly doubled since early January, compared to a 35% spike in Nasdaq Composite Index. Investors could still see long-term returns from buying this market-beating stock now. Take a look at a few reasons why. Like all of its peers, Shopify endured growth hangover in the second half of 2022, but demand trends have stabilized and appear to be on the upswing. Hmm. Okay, it goes on and on and on, but this is it for today. Hmm. I feel great because it's always interesting to read stock articles. Anyway, this is it, and I'm gonna see you tomorrow. Okay, bye bye, and have a good night. Bye bye.